Jeff Verdon is our next speaker. Jeff, why don't you come up? Jeff Verdon is the top attorney in Southern California. I've known Jeff for many years. Wonderful man who really knows his stuff when it comes to tax advice and estate planning. You know, these things are so important. You remember Alex mentioned the importance of taxes and how taxes affect your investments and estate planning and so forth. And Jeff is really the best person I know of. He's going on a cruise here next week.
I am.
We're looking forward to that on our Asian cruise. And so please give your attention to Jeff, who I'm not sure what you're going to talk about, but please
I'm not
tell
either.
us. Okay, there you go.
Thank you. Good morning, everybody, and welcome. Thank you for that lovely introduction, Mark. My name's Jeffrey Verdon, and I am a lawyer. I'm a tax lawyer, and I want to bring a different perspective to investing during this conference this week. We help our affluent families and business owners with estate planning, tax planning, and asset protection. And we like to say we help our investor clients grow their net worth using the tax code, which a lot of you investors seem to ignore when you do your investing. I want to cover the three must-haves for 2014. Let me get right into those. Income tax efficient portfolio management. How would you like to be able to take your taxable portfolio income and convert it into tax-free income using something called private placement life insurance? And you'll see how that'll dramatically change your returns. By a show of hands, how many of you in this room own life insurance? Well, not that many. How many of you own life insurance and pay your premiums with finance? You finance your premiums. Just one or two. I spoke about this last year in Tampa, and it was the most popular subject of the group that I talked about, so I brought it back this year. I want to touch on that as well, using intelligent leverage to pay for your life insurance premiums. And finally, those of you from high tax states like California, New York, and New Jersey, I want to show you how you can move your portfolio to the state of Nevada. Instead of you going to the state of Nevada, move your portfolio to the state of Nevada, put it into a special kind of a trust called a Ning trust, and stop paying California state income tax, which is now 14.3, or stop paying the high taxes in the state that you come from. So let's get right into this. Tax-efficient portfolio management is something that many investors often ignore. And I think when you sit down to analyze how successful you were in your investments, you really have to look at the after-tax returns, not your pre-tax returns. The after-tax returns are those returns that you have after you pay Uncle Sam your taxes. It's the cornerstone of any good tax and financial plan. Now, we now have the highest income tax rates, highest tax rates in a generation. 23.8% for capital gains, ordinary income tax up to 40%. If you live in California, we just increased our state income tax to 14.3%. And if you live here, you have a combined state and federal tax approaching 57%. So it's pretty tough to make any money in this kind of environment. So let's say you had $1 million and you wanted to invest it. And you had a choice of putting it into your living trust and investing that way, putting it into your family limited partnership or LLC, investing that way, or possibly putting it into a life insurance policy because you learned this morning how tax efficient these things are. So you call up your Pacific Life agent, and I'm picking on Pacific Life because they're just up the road in Newport Beach, and you give your agent $1 million, and he puts it into a policy, and you tell your agent, I want you to invest that money in the Vanguard Index Fund. And that year, that Vanguard Index Fund goes up 10%, you make a $100,000 profit inside of your policy. And then you tell your agent to get out of the Vanguard Index Fund and go into one of the private equity funds that Mark talked about. Well, Vanguard's not going to send you a 1099. Pacific Life's not going to send you a 1099. Why? Because since the tax code was enacted in 1913, interest, dividends, and royalty income earned inside of a life insurance policy or an annuity is not subject to tax. But folks, it gets better than that, because you can withdraw that $100,000 profit you made in your policy out of your policy 100% income tax-free by borrowing it, much like borrowing money out of your equity out of your real estate. When you die, the proceeds of that policy pass to your beneficiaries income tax-free, and if you structure the policy properly, it is excluded from estate taxes and it's protected from your creditors. So folks, life insurance is the penultimate tax shelter in our tax code, and most of you don't know this. So if you were earning, let's say, An 8% return on ordinary income, it's like earning a 14.1% return after tax. At 10%, it's like earning 17.7%. If it's capital gains and you're making a 10% return, look at the increase, 13.1%. So tax-efficient portfolio management is a theme I'll be talking about a lot in my workshop this afternoon. So this is how we typically structure a private placement life insurance. I don't have time to get into it this morning, but I'll get into more detail in my workshop this afternoon. Here we go. Here's an example of a 40-year-old male who's going to put $2 million a year away in premium for 5 years, and he expects a 10% return. Half the portfolio is going to be taxed at ordinary income tax rates and half at capital gains rates, with about a 50% annual turnover. You can see from this chart, I don't know if you can see it in the back of the room, but the first year, the private placement life insurance policy is a little bit less than the taxable account because of the fees and costs to set it up. But look what happens in year 5. Significant difference. In year 10, and this is a 40-year-old, it's now about $2 million better. And in year 20, he's pulled away, and there's a $10 million higher value in the private placement policy than in the taxable account. And on the very right-hand column, you can see all the life insurance death benefit that the person also got along with his tax-sheltered account. So it's a very important strategy, and for you investors at this conference, something you should know about. The next thing I want to talk about is premium financing, financed life insurance. Now, most of us in this room don't mind owning life insurance. We just hate to pay for it. So what if you can have all the life insurance you needed or wanted, whether it's to pay your taxes, whether it's to create a secondary estate for your children and grandchildren, but instead of taking money out of your portfolio, leave it there where you're earning 6, 7, 8, 10% or more, and borrow the money from a lender, a special lender, at 2% or less, and use that money to fund your premiums every year, and just pay the lender back interest only. In fact, you can pay the lender back out of your portfolio earnings because you're going to make the arbitrage, the spread. And then when you die, the insurance company cuts 2 checks. One back to the lender who loaned you the money for your insurance, and one to the beneficiaries who get the balance. So here's an example, and I'll go through this in more detail this afternoon. Here's a 62-year-old and a age 60 couple, who bought a $30 million life insurance policy. Now, their joint mortality is 28 years. If they bought it conventionally, they would have paid $286,000 a year for 28 years, or $8 million in premium. If they had financed the premium and borrowed the money from the lender, they would have paid $2.5 million at mortality. So you can see they would have saved over $5 million in cash flow, which could have been left in their portfolio, and the internal rates of return are significantly higher. So this is just an example of how premium financing can work for you. And finally, I want to talk to you about what to do if you live in a high tax state. California, as I mentioned, bumped their tax rates up to 14.3%. So I want to introduce you to the NING Trust, the Nevada Irrevocable Non-Grantor Trust. It's hard to say, so we call it the NING Trust. It's a way to keep your capital that you would have paid in state income tax in the family and use, instead of going out and buying a new car or expending the money for stuff, for toys, keep the tax savings in your structure and create wealth with it. So here's an example of what you can achieve. Let's say you had somebody with a $10 million portfolio earning 6.5% rate of return annually, and they were in the highest marginal tax rate in California, 14.3%. That's $92,950 a year in income taxes you would normally pay. So if we can save that $93,000, rounded off, over the next 25 years, we have over $23 million in our family trust, plus the return that you would earn on that. Now, what do you do with that? As I say, take the tax savings and do something constructive with it. Create additional wealth for your family. Now, in this example, and again, I'll go into more detail this afternoon, this person has 3 choices. Over 18 years, that $93,000 in savings amounts to $1.6 million in total savings. So that's what you see in the top column. He can either give that to a stockbroker to invest, and if he invested at 6.5% and a 40% tax bracket, figure average, in 20 years, that person could start pulling out $350,000 for 8 years. If instead he gave that $93,000 to his insurance agent and paid premiums every year, in 20 years, he could start pulling out $350,000 for 10 years because of the tax shelter in the policy. But in the third example, if he set up a NING trust and then use the Ning Trust to use the tax savings to pay the interest on a loan he borrowed to buy an insurance policy where the premiums were front-loaded into the policy, that person in 20 years can take out $350,000 for 20 years, or double what they would have been able to take out had they just put it in a conventional policy. So these are the things I want to talk to you about this afternoon. These aren't for everybody, I recognize that, but if you are in an area where you want to learn more about tax efficiency, more about premium financing, and more about how to shelter tax in the high tax state, come to my workshop at 2:40. We have a booth here in the room, and we'll be happy to answer any questions you might have. I look forward to seeing many of you this afternoon. Thank you.